April the 6th, 2026, the United Kingdom dismantled a tax framework that had been in continuous operation since 1799. 225 years of non-domicile status, the cornerstone of global wealth migration into Britain, came to an end with a stroke of parliamentary legislation. If you are a high net worth individual or a family office principal, this briefing is the most financially consequential 15 minutes of content you will watch this year. We are not here to generate alarm. We are here to map the structural reality. The Finance Act 2025 has replaced traditional domicile with a raw statutory test, the 10 out of 20-year rule. If you have been a resident for a decade, the UK government now claims a 10-year shadow over your global estate. The clock is no longer on your side. This isn't just about higher rates, it's about jurisdictional risk. When the rules of a G7 economy change this radically, your only defense is structural arbitrage. The remittance basis is officially dead, replaced by the FIG regime, foreign income and gains. For the established non-dom, this isn't a policy tweak, it is a fundamental cliff edge. While the government presents this as a modern simplification, the window is slammed shut after just 4 years of residency. If you have been in the UK for more than 4 years, you are now effectively in the line of fire for worldwide taxation. You cannot simply fly away and assume the liability vanishes. You need a strategy that accounts for the new legislative architecture. Previously, your domicile was the shield that kept your global estate safe from a 40% death tax. Now the government has introduced a tail. Even if you move to Dubai or Monaco for 10 years, your wealth remains tethered to the British Treasury. For a family office managing multi-generational wealth, this is a structural disaster that requires proactive, multi-jurisdictional planning. Under the old rules, you could shield foreign wealth indefinitely by paying a flat charge. Under the new FIG rules, that relief is restricted to your first 4 years of tax residency. By year 5, you are fully exposed. This is the 2026 tax bottleneck, and the winners in this migration are those who move while the exits are still wide open. Look at this decay, a decade of exposure after you've already departed. If you leave after 10 years of residency, the UK keeps its claim on your global assets for another 10. You risk losing nearly half of your global legacy to a jurisdiction you no longer inhabit unless you execute a 6-month roadmap before the deadline. Think about the mechanics of a worldwide estate. Every asset in every jurisdiction is now flagged with a 40% liability overlay. This forces a pivot toward jurisdictions that offer stability and a rational approach to capital. Specifically, we are seeing a massive surge of interest in the southern pivot towards South Africa. There is tapered relief, but it is limited. If you are a family office principal, you must look at the gold bars on this chart, representing the final years of exposure. The delta in net worth preservation after factoring in IHT tails and capital gains is often in the range of 15 to 25%. On a £10 million estate, that is a £2.5 million difference. Departure timing is now a mathematical calculation. By October 2025, your segregation structures must be in place. By January 2026, your residency applications should be submitted. If you wait until the 2026 tax year begins, you are reacting to a crisis rather than executing a strategy. The Temporary Repatriation Facility, the TRF, is a critical window you must not ignore. For the 2025 to 26 and 2026 to 27 tax years, you can bring foreign income and gains into the UK at a flat rate of just 12%. Compared to standard 45% rates, this is an incredible discount. But once that window closes in January 2027, the cost returns to punitive levels. To qualify for the TRF, your foreign income and gains must have been generated pre-April 2025. This requires an immediate checklist, audit your accounts, verify eligibility, and move the funds while the designation is still available. If you need liquidity for UK-based investments, this is your designated time to act. Stop. The biggest logistical hurdle is clean capital segregation. If you commingle your offshore funds with new income after the deadline, they become tainted. You lose the ability to remit that clean capital tax-free, potentially triggering massive liabilities. You must open entirely new bank accounts and shift to new corporate structures to separate your initial capital. This four-box process ensures that funds flow into the correct clean silo rather than the mixed trap. It is a technical maneuver, but it is the only way to protect your existing wealth from the income first rule. When funds are mixed, HMRC assumes the most tax layer is remitted first. This income first trap can turn a simple transfer into a 45% tax event. By structurally segregating now, you preserve the identity of your capital. This requires coordination between tax counsel and your family office advisors. The TRF election is irrevocable. When you fill out your self-assessment, checking that box triggers a definitive tax treatment. You must ensure your notice is submitted correctly to avoid missing the window. In an increasingly aggressive OECD world, transparency is mandatory. We must also consider the CRS reporting context. Data now flows seamlessly between jurisdictions and the HMRC hub. You cannot hide assets, you can only structure them. Moving to a jurisdiction like South Africa isn't about evasion, it's about diversifying your jurisdictional risk and regaining agency. Look at the CRS network. Jurisdiction dots are connected and the information flow is absolute. To survive this, you need a network that understands jurisdictional risk before it becomes law. You aren't just moving capital, you are moving ahead of a legislative curve that is being poured in concrete. Let's look at the lifestyle arbitrage. In Cape Town, the equation is inverted. You get a world-class lifestyle at a 70% currency discount. When we run the metrics, the difference in net worth preservation between staying in the UK and moving to a structured base in SA is staggering. A luxury London two-bed flat often comes with high carrying costs and a 40% IHT burden. For a high net worth individual, that represents a low yield, high liability asset. By pivoting your capital to the Southern Hemisphere, you transition from a jurisdiction that no longer prioritizes you to one that offers massive upside. Contrast that with a Clifton Villa. For a fraction of the London price in Z terms, you are acquiring a high-yield, hard currency hedged asset. In the Atlantic seaboard, Clifton and Camps Bay, we have seen rental growth hitting 34% year on year. This is a strategic real estate acquisition in a territory with global demand. Cape Town's net yields are now leading global cities. While London sits at 2.5%, the Sea Point and Constantia corridors are delivering closer to 8%. You are protecting your lifestyle while growing your equity in one of the world's most resilient luxury markets. Understanding these micro markets is the difference between relocation and wealth preservation. The key to managing this is the residency clock. To avoid becoming a South African tax resident and triggering worldwide taxation there, you must spend less than 183 days in the country. For the global nomad, this allows you to enjoy the summer months in Cape Town while your tax home remains elsewhere. This circular dial shows your zones, safe, monitor, and resident. Precision diary management is essential. By establishing a legal footprint through the remote work visa, you gain a plan B that functions as a plan A for wealth creators looking for a long-term base. The South African remote work visa is your entry point. The threshold is remarkably accessible. A confirmed annual gross income of R650, 976, approximately £28,000. For a high net worth individual, this is a negligible barrier for such high-tier flexibility.
Step 1 is the residency application. Step 2 is meeting that income threshold. This roadmap leads toward a permanent residency pathway over 5 years. It allows you to move your center of vital interests legally and structurally, avoiding the 2026 tax bottleneck in the UK.
For those with existing trust structures, the landscape is treacherous. The abolition of excluded property status means assets previously shielded from UK IHT are being pulled back into the net. If you are a settler, your worldwide trust assets are now exposed and require elite-level restructuring to avoid disposal charges. The UK-SA double tax agreement is based on the OECD model. Understanding the withholding rates and tiebreaker clauses is essential for cross-border families. This is jurisdictional intelligence that defines the wealth migration landscape. ensuring no single government has total control. We must also account for legislative volatility. Heading into 2030, risk markers are present in every G7 economy. By aligning yourself with a community that monitors these shifts daily, you move from a position of vulnerability to one of strategic advantage. Knowledge is the only hedge against overreach. I'm Giuliano Giacovazzi. We have covered the UK's 10-year trap and the South African exit. Join the Global Wealth Migration newsletter for off-market property alerts and technical updates too sensitive for a public platform. Secure your legacy, and I will see you in the next episode.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.